My name is Monika Hengesbach. I'm an enrolled agent with Decision Financial Services, and welcome to The Wealthy Wallet. The purpose of this podcast is to give you tax tips, tax strategies, information on new tax law changes, and give you new tools to help you navigate life's unexpected financial curveballs, all in hopes to give you more money to put back into your wallet. So today, what I wanted to talk about is why hiring children might be a good thing for you. As we know, children can be rather expensive, and I actually did a little research, and LendingTree looked up that data, and it says that to raise a small child for 18 years, it costs $237,482. That's crazy if you put that into what you could possibly be spending with that money. And that doesn't even include their college education or any other unexpected things that may arise while they're growing up. So when a parent has their own business, I mean, there's quite a bit of other reasons why hiring a child would be very good to put in your family business. I mean, of course, giving our children responsibilities is always a wonderful thing. It gives them empowerment. It helps build their self-esteem. I remember in my practice when my daughter was 6 years old, her role was to shred paper, and she loved it. She was excited about shredding paper. Mind you, I didn't get very much shredding in the paper box. It was all strewn through the office, but that was okay. She had fun. We were able to work together. It was something that we can share. And to this day, and she's now 22, she still talks about shredding paper and earning enough money to play sports. So let me tell you some of the key IRS tax laws that you have to follow to hire your children. The first one, it needs to be reasonable compensation. So you can hire your children starting at the age of 7, that happens to be the most recent tax court case, up until the age of 18, and pay them what is deemed reasonable compensation. What's reasonable? Well, that's really a hard number to quantify. For example, the standard deduction in 2024 for a single individual, so your children, is $14,600. So you can technically pay your children $14,600 a year. Would it be your 7-year-old putting flyers out on car windows and maybe only spending 2 hours and that's it, justify receiving an annual salary of $14,600? I don't think so. So we have to look at how many hours that they're working for you, what is their job role, job description, and pay them according. In a sense, it's what would you pay a non-family member to do the exact role? That's what you need to pay your children. That would be what is deemed reasonable. The second thing, it must be authentic and legal. So when we hire employees to work in our company, they have to fill out a tremendous amount of paperwork. We got to fill out a W-4 form. We got to fill out an I-9 form. Your children need to do the same thing. And lastly, it's documentation. So you need to have a job description. You need to have job duties listed out, exactly what time they're supposed to come into the office, when do they perform these duties, how do they perform these duties, and what they're going to get paid for doing those duties. So the business structure of the family business determines what taxes need to be withheld. So if you're a sole proprietor, and by sole proprietor, what I mean is you wake up one morning and you say, you know what, I'm going to make widgets. And you put the shingle out on the front door and you start your business, that's considered a sole proprietorship. If you decide to go down more of a legal path and set up an LLC and it just happens to be you and or your spouse, that is considered disregarded in the IRS rules. So a single member LLC or a sole proprietorship, you can pay your children up to the age of 18 that standard deduction if that's a reasonable compensation, and not withhold any form of taxes. That's federal, that's Social Security and Medicare. Your children will pay zero tax, and your business just benefited from getting a write-off of $14,600. Now, if you went with just happens to be a really great tax strategy, and I'll bring this up in a different podcast, but let's say you changed your sole proprietorship or your self-directed LLC, and now you're having it taxed as an S corporation or a C corporation, you still followed the same IRS rules that I mentioned. The salary needs to be reasonable. It's got to be authentic. You need to document everything. The difference in this is you don't have to withhold federal income tax because your children are not going to pay any tax up into the standard deduction, but you do have to withhold payroll tax. And that payroll tax is the Social Security and Medicare tax. Now, if we think about the tax savings, you can even increase those savings if you added a retirement plan for your children. So imagine this. You set up a SEP IRA, one for yourself and one for your children, all under your company. You can pay 25% of their salary. So in the case of the $14,600, I have that written down somewhere, I believe, it comes to $3,650. So now you get to write off $18,250, and your children pay no tax on that, and you actually get to lower your taxable income by that dollar amount. It's a win-win. And if you add a solo 401k or 401k, you can write off quite a bit in profit sharing and the like against W-2s and your business. Now, I know the thought of here's my 7-year-old and I'm already paying into a Social Security and Medicare system and having a match on that, and that doesn't really seem like it's saving me a lot of money. There is a workaround to that. And that is if your business is an S corporation or your business is a C corp, what you can do is establish what is called a family management company. And the family management company's sole purpose is to manage the operations of your S corp. So what does that mean? They're the ones that hire your children. They could be doing the bookkeeping for your children, and they are keeping the documentation on the job description for your children. What ends up happening is that family management company, which now is a sole proprietorship, charges your S corporation a management fee. Your S corporation still gets the write-off. They get charged, let's say, a management fee of $18,000. The S corporation still gets that write-off of $18,000. It gets paid to the family management company, and then the family management company gets to pay your children. Guess what? That is a sole proprietorship. That means there's absolutely no Social Security or Medicare tax having to be deducted. So it's an additional savings. So that's really all that I have on this little tip. If you want any other information or you would like to see how possibly this can work for you, please reach out to us. You can check us out at my website, www.decisionfinancial.com. And what I would absolutely love, if there's any questions or any struggles that you may be having navigating the tax world, shoot me those questions that you would like me to address. And the next time that I'm doing one of these podcasts, I will gladly answer all those questions. Okay, thank you very much. Bye.